Why is debt? So it's going to why is debt? No, hang on. This is not debt means the debt that you borrowed. This is debt securities, which means debentures. So this is debenture securities or bond securities, which are called as debt. So this is investments made in debt securities. Let's say today you bought an RBI bond or a gold bond. You're aware of RBI gold bonds, right? That
Yes.
is a debt security because that security is an obligation of the RBI to pay you back, but that's your asset.
Okay.
Got it?
Yes, yes,
Good,
yes.
good,
Okay.
good question. Because people in India, we say debt is an obligation, but this is debt security investment. Okay.
Right. Yes.
Sure. Let's move on. Very good. So what are the main issues? See now, because they're long-term asset, right? We have to be very careful because we are going to record them and take them to next year. So we cannot make a mistake in accounting for it, right? So the key issue is what is the actual cost of the long-term asset? What is the allocation cost over time? Because don't forget, this cost cannot sit forever. I have to depreciate it or amortize it. So I need to decide how do I amortize it? On what basis? That is called allocation. Clear? And the third and the more critical issue is later, if I incur further cost, what do I do with that? If I bought a building, I did some renovation work, the useful life went up. Will I capitalize it? Will I expense it? I paint the full building. Do you paint it every year? No, you paint it every 5 years. Should I capitalize it? Should I expense it? So whatever costs I incur later for the asset, how to record it? Should I add it to cost or should I expense it? So these are the main issues that you want to focus. Cost, depreciate, further cost. Here, this is what we normally will understand. So the cost part has come later. Let's look at impairments and then we'll go to cost. Okay. So what is impairment? Now, impairment concept is very critical for long-term assets. Okay. Because assets are more than 1 year. So it is possible that 1 year was good. The next is suddenly impaired. Example, AI. Everyone knows artificial intelligence. So something that was a great thing last year, this year may be useless because AI took over. Right? So the times are changing. So your job is to make sure that over the period of the asset, there is no impairment. Okay. Now, what is impairment? Exactly. What is impairment? Impairment is basically a condition where the asset value in your books, right, has suddenly gone above the recoverable value. Means the asset is 100, but you will recover only 80 or 70. That means the asset is not worth the recoverable value. Got it? So when the recoverable value falls or the asset value goes too high compared to value, you are having a situation of impairment. Means the asset useless. Now, what exactly is the recoverable value? Now, this is an important formula. Recoverable value is basically you're using the asset like NRV concept. NRV was what? Market price minus selling cost. Same thing, fair value minus selling cost. Or the value in use. Basically, if you use the asset for 5 years or 10 years, what is the present value of the future cash flows? Which we did use a CFA calculator, same funda. So either you take the value in use or the fair value, whatever is the greater number, you will put that as recoverable value. And then you will compare it to your cost. If that amount is greater, very good. If it's less in cost, impair it. So 2 steps. First, find out these two. Get the greater value. Compared to the cost, get the lower value. Are we clear? Okay. If it's impaired, you write down. Same in funda. If you write down, can I write it up again? Once I write down, can I write up next year? No, it's not. Same funda. Okay. It's allowed only to the impairment loss. Now, in US GAAP, it's not allowed. Okay, write a little loss. If loss is allowed only up to original loss amount, the original loss. But this is for IFRS. US GAAP says prohibited. So in India, in stock inventory, what I told you, I can write off, but IFRS, I can't write off for US GAAP. Same fund there. I can write off for IFRS, I can't write off for US. Are we clear? So the concept is more or less same. Clear? Now, what is different under US GAAP? IFRS says find the difference, find the impairment, record it. US GAAP says you first test for impairment. You first see, is there impairment? Then you will compute. So IFRS, US GAAP says, I will first identify impairment and then recognize the loss. Now, when I identify impairment, it looks at undiscounted cash flows. Here, I look at discounted cash flows. Present value means discounted cash flow. So IFRS does not look at discounting. It says always discount. But US GAAP says, first find undiscounted cash flows and see if it's impaired. And then if it's impaired based on undiscounted, then you will go ahead and record it based on discounted cash flows. So first you test by using undiscounted, then you compute by using discounted. Are we clear? That's the only difference. So what's the only difference in US GAAP? There's an extra step of identifying impairment. First you identify, then you compute, then you record. IFRS says don't identify, just compute and then record. Are we clear? Also, second difference is you are not allowed to reverse it in US GAAP, but in IFRS you are allowed to reverse it. Clear?